Hey guys, this is Jonathan Tran from Paramedic Financial and Finance in 5 to 10 minutes. We're back again here to continue our series on life insurance. This time we're talking about how to use life insurance as an alternate investment vehicle or supplemental retirement account. Some people may think, whoa, what are you talking about, Jonathan? Life insurance is life insurance. But no, nowadays, if you structure the life insurance properly, there is a way to use the life insurance that has tax advantage benefits so that when you retire, you have another stream of income that you can use through your life insurance. Why I bring this topic up is because doing a lot of planning for business owners or people that are professionals or those who just want to save more money, a lot of question has come up saying, hey, you know what? I already save in my 401k, I save in my IRA, I save in my Roth IRA, I save in my health savings account, HSA, I save in 529 plan. I maxed out everything, Jonathan. I'm a great saver, right? Great. Where else can I save money? Where else can I put money, but I don't want to pay taxes. I want to minimize the amount of taxes I'm paying. Well, life insurance is another tool that you could use in your financial portfolio that you could fund money into there if you do it right. You can still have some life insurance to leave behind for your family, but the true goal of you getting the life insurance is to accumulate more money in the policy that grows tax deferred, meaning that all the interest that grows into your life insurance policy now is grown tax deferred, meaning you don't need to pay taxes today. You may pay taxes later, but the special way the life insurance works is that later on in the policy, as the policy grows and you are growing the cash value in the policy, you're able to access the policy in the form of loans. So meaning you're not technically withdrawing the money out, because if you withdrew the interest out, you would have to pay interest, right? But in this case, we're leaving the interest inside the account and we're loaning against the policy, which doesn't trigger a taxable event. Now, you may say, hey, I'm loading it out. Do I have to pay an interest rate? Yes, there are companies, they all have an interest rate that allows you to withdraw money at a certain rate. And then you can either pay it back, or when you pass away, they'll deduct the loan balance plus the interest from your death benefit, and the remainder goes to your family. But some companies, if you keep it long enough, they have a crediting feature that will credit back that interest to your account, hence so-called washing out the interest that you pay. And then you have a tax advantage account where now you don't have to pay the taxes because, one, you're getting a credit back on your loan, right? So how does that look in terms of numbers? So let's just say that you already maxed out all your savings, and a lot of these people now, they have about an extra $1,000 a month they want to save. So what does that look like for somebody who's maxed out all their savings and are looking for more ways to get tax advantage and not have to worry about paying taxes later? If you use a life insurance policy, and this is, say, a 40-year-old male, okay, this is assuming you paid off all your debts, you're really good at saving, you have an extra $1,000 a month, this would buy you at minimum about $220,000 of life insurance. Not much, because our goal is what? Well, our goal is to buy the least amount of life insurance possible and put the most amount of money into the cash value as possible. So say that 40-year-old male puts $1,000 away, that's $12,000 a year. By the time they're 65 years old, in 20 years, they would have put $300,000 in there. So I did some illustrations here just to give some hypotheticals. We don't want to overpromise people, but we just do a very conservative number. So let's start with 6% interest. If you averaged about 6% interest a year, by the time you were 65 years old, you would have about $550,000 in your account. That's quite a bit, right? You put in 300, you got it 550, it's not bad. But the key thing is what? You get to take this money out tax advantage, right? How much can you take out a year? So say you retired at 65, and from 66 years old to 80 years old, you'd be able to take out $51,000 a year. Now, Social Security, most people Social Security, if you've been contributing to Social Security for a long time, the average is about $1,500 to $2,000 a month, right? So about $18,000 to $24,000 a year, and you've been working all your life, and that's all you get. But here, this person, for 20 years, put hard-earned money, $1,000 away. By the time they retire, they have $51,000 tax advantage for them to take out a year. If they pass away at 80 years old, because you took money out of the policy, your $200,000 policy, you would still be able to pay out about $70,000 to take care of your funeral costs, right? Now, what if you got 1%? Your account from 550 would be now about 631,000 at 65 years old. And now you'll be able to take $64,000 out a year tax advantage. If you pass away at 80, you would get about $76,000 of death benefit. So just getting 1%, you get $13,000 more a year. Now, what if you can get 8% interest, right? It's not too far-fetched. You know, a lot of investments, if you look out there, you know, they're averaging over time pretty good, right? So let's just say that you got 8% a year average. Your account would be about $731,000 if you put in $300,000, and now your annual income would be $79,000 a year. Is that a nice retirement, semi-retirement? This is just supplemental, right? So say, for example, if you had this life insurance, you had your Social Security, and you got 8%, you already had $100,000 a year income, right? And this is not counting your retirement money, your Roth IRA money, any other money that you have, businesses you have, real estate. You have a solid retirement because you have multiple streams of income, right? So it's always good to explore all different types of life insurances, different types of investments. I mean, make sure you understand a little about everything, know what your choices are, because you know there are some really nice things out there. And one thing I want to share, one more before we go, is what if you were to set up a program like this for your child? They were born 1 year old, right? My daughter, for example, I started this program for them, $150 a month, right? And if we just kept that $150 going a month until she was 65 years old, she would have about $1 million in her account based on 7% interest, right? That's $112,000 a year supplemental retirement tax advantage income for her. Basically, you know, I set up her retirement for her. Now, I don't know what inflation is going to be like then, but hey, if she can get $100,000 of income a year from something that mommy and daddy did for her, she was 1 year old, I think that's a pretty good trade-off, right? So I hope you guys found this very useful today. You know, life insurance as an alternate way of investment for your retirement future or for your children's saving future. Definitely look into it. Thanks for tuning in for us. See you guys next time.